Hang on. Stop. Well, good afternoon and welcome to our HiRock clients and any other listeners who have joined us this week. And thanks for taking the time to tune into our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson. I'm joined by my partner and colleague Paul Tepsich, the founder of HiRock, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. Our financial planner, Bianca Tomlinson, is also on the call, and I know that she's been working on lots of well forecasts recently, but that means that our new clients are all being well taken care of. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HiRock tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what happened last week. Now, our overriding theme for 2016 is that financial markets will remain volatile. January and early February saw a spike in volatility, but markets have settled some thanks to continued monetary stimulus by central banks. However, we are only 1/3 into the year and far from being out of the woods on more volatility. There's still a great deal of uncertainty in the world, and we think volatility will certainly be part of the rest of the year. We focus a lot on the U.S. economy and whether it will be able to grow while less positive global economic forces provide a drag. Now, in the first quarter, the consumer, who represents 2/3 of the economy, remained on the sidelines, and the economy grew at a very slow 0.5%. The start of the second quarter looks somewhat more promising as the consumer has come back into buying mode, or so there are early indications to this extent. Despite this, our recession indicators continue to show an increasing probability of the potential for a U.S. recession in the next 6 months or so. Commodity prices, and especially oil, have been trending higher after a prolonged decline. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy, leaving inflation-guided central banks considering what to do next. The focus has turned to the U.S. Federal Reserve and their desire to see higher interest rates. Now, as other central banks around the globe lowered interest rates and added monetary stimulus, the U.S. dollar strengthened and in turn stalled out the U.S. economy. However, if the economic outlook improves on consumer activity and enough to encourage the Fed to raise rates, we think that will likely bring a greater chance of recession as the yield curve flattens, a bit of a catch-22. I will revisit this a little later in our call. Well, geopolitical wildcards like the UK leaving the European Union, the US presidential election campaign, Saudi Arabia, Iran, OPEC, and other oil-producing nations, Russia, China, and North Korea, terrorist activity, and a refugee crisis are all increasing the levels of uncertainty, and it is this uncertainty that we believe will create higher levels of volatility as time progresses this year. Now, we continue to watch the bond markets and yield curves for clues of timing and direction. Now, we're pretty much through the first quarter earnings season and the fourth consecutive quarter of negative earnings growth. The last time earnings growth had 4 consecutive quarters of negative growth was in the period of 2008-2009. Investor sentiment is low, yet stock markets remain within small percentages of their all-time highs despite a sell-off earlier in the year. And an interesting dilemma it is. But history shows us that stock markets don't usually fall heavily until we are well into a recession. Now, we think stocks are expensive and are inclined to think that a good sell-off may not be that far into the future. Now, the period from 2009 to 2014 was a time of better than average returns for balanced and diversified portfolios, but the cycle of economic activity has slowed and growth and inflation are no longer providing those kind of returns. There is a tendency for some investors and traders to pursue greater risk to improve their returns. We think that this is not a good investing strategy. In fact, we believe that investor portfolios need to be revisited and allocations adjusted to ensure that strategies are providing appropriate risk-adjusted returns consistent with the current investing environment. Okay, so let's have a look at what's been driving markets over the last week. Volatility has picked up a little, but is not anywhere near where we were at the beginning of the year just yet. And it remains well below its longer-term average. CNN Money's Fear and Greed Index hit a low near 9 back in January. Excuse me. Now, while still in greed territory after more stimulative central banks forced money out of low and negative yielding safe assets into riskier assets, it is starting to slip from its higher levels in the 70s last month. Markets moved rather quickly from oversold to overbought in March. We do believe that the next move is going to take us lower. Since our last webinar, our benchmark World Equity Index is off by just a little under 1.5%. It is now flat on the year. The Australia All Ordinaries Index was the best performer since last Tuesday, and the S&P 500 Index was the worst performer. The TSX has been the best performing country index in the developed world this year. The Canadian REIT Index has also done extremely well. We have an allocation to the REIT asset class in our global equity model. Now, since the beginning of the downtrend in our benchmark All Country World Index, there have been 2 periods of interim short-term rallies, but in both cases, these rallies failed to make new highs, which signals that the longer-term downtrend channel has been reconfirmed with lower lows and lower highs. The likely next scenario will be to test buying support. This could possibly take us to the bottom of the channel, which would appear at around the 48 level. Further 15% drop from where we are at the moment. Meanwhile, volume has been on the down days, has been higher on the down days than on the up days, which tells us that sellers do have a greater deal of ammunition. Very little changed in fixed income markets, although high yield was the best performer and the Canadian Preferred Share Index was the worst performer. U.S.-Canada 10-year spreads widened this week to 46 basis points from 43 last week. Pardon the typo at the top of this chart there. They have been as wide as 95 basis points back in January. And the Canadian Preferred Share Index has been a discussion point for us of late. Paul and I have focused on them in our blogs recently, including dividends. It has returned a fairly hefty negative 15% over the last year, and we do not think there is hope to the upside anytime soon. Canadian banks have been falling behind their U.S. and European counterparts on a key gauge of their strength, and as we mentioned last week, we think they will have to raise Tier 1 capital to play catch-up. The cheapest way for them to raise capital is through the issuance of preferred shares, and the vehicle that they are most likely to use is the fixed rate reset preferred shares that dominate the Canadian Preferred Share Index. Now, this additional supply will potentially push prices lower again as we've seen from previous experience, demand could not keep up. Well, oil showed more strength as supply concerns were reduced, and copper, sometimes referred to as a key gauge for the global economic growth, fell again this week, albeit it was a very marginal decline. And after hitting bottom in January, trending higher, copper appears to be now breaking down. We will have to keep our eyes on that. Meanwhile, oil remains in the uptrend that began in February. The Bloomberg Commodity Index also continues its uptrend as well, but is off its recent highs. Now, after touching 80 cents US, the Canadian dollar fell off a cliff after the Fort McMurray crisis. Meanwhile, oil has continued higher, so that correlation still is not back in line. Our benchmark world benchmark world equity index is comprised of about 53% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy and we think that things there are looking a little bit scary. We wait to see who becomes the next president. Clinton does seem to have a clear lead at the moment, but that has been narrowed since last week's report. At their meeting, sort of latest meeting a few weeks ago, the Fed indicated that it was less worried about global economic issues, but still concerned about slowing U.S. economic growth. In fact, economists have reduced their expectations of an increase in interest rates when the Fed meets in June. Now, as we talked about last week, the past 3 U.S. recessions have followed on the heels of an increase in the unemployment rate that takes it through its 36-month moving average. Now, the rate of decline of the current 36-month moving average, currently at 6%, is fast and steep, and if projected, should hit the 5% level in a matter of months. Even a slight uptick in unemployment from its current level may indicate that a recession could be imminent, especially if the U.S. Federal Reserve decides to raise interest rates, and we'll get back to that in just a moment. Now, importantly, the weekly U.S. jobless claims data from last Thursday showed a surprise spike, and that may foretell of weaker jobs data in the future that could, in fact, push unemployment higher. Meanwhile, the consumer, as I mentioned earlier, stepped up with automobile and online purchases in April. And today we saw slightly higher CPI data, but lower core CPI data without the more volatile food and energy components. The Fed will pay greater attention to the personal consumption expenditure core price data to be released later in the month. And finally, industrial production looked a little better in April after a big drop in March. All in all, with the increased consumer activity but a decreased forecast for real residential investment growth, the second quarter GDP data is expected to grow at approximately 2.5% rate. Well, elsewhere in the global economy, after all the monetary stimulus from the European Central Bank, the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China, the early results are not pointing to any significant improvement. And as we like to tell you each week, the broad and diversified benchmark equity index, which we use to gauge the performance of our model and portfolio performances, covers almost 2,500 companies domiciled in about 23 developed countries and 23 developing countries. As a result, we very closely watch how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. As I said before, more than half of the companies are domiciled in the U.S., about 16% in Europe, 7.5% in Japan, 6.5% in the U.K., 3% in Canada, and about 2.5% in China. Well, in last week's decision on interest rates, the Bank of England stated that in the UK, activity growth slowed in the first quarter, and a further deceleration is expected in the second quarter. There are increasing signs that uncertainty associated with the European Union referendum has begun to weigh on activity. The latest poll results show a very close call as to whether the UK will decide to remain in the European Union at the referendum that is to be held on June 23rd. Now, year on year, the Eurozone economy expanded at a 1.5% rate, slowing from a 1.6% expansion in the final quarter of 2015. That is lower than the preliminary estimates of a 1.6% growth rate. In Japan, industrial production increased by 0.2% in March, but remains stuck in neutral, basically for all intents and purposes. Here at home, in March, manufacturing sales decreased 0.9%. Now, Ontario manufacturing sales fell the most at a rate of 1.9%. Inventories fell 0.4%, and as a result, the inventory to sales ratio rose to a level of 1.3 in March. Now, a rising inventory to sales ratio reflects slower economic growth. In China in April, industrial production rose 6% from a year earlier. Now that's down from a 6.8% rise in March and below forecasts of a 6.5% growth rate. So where do we see all of this taking us in the future? Let's see what bond markets are telling us. And as regular listeners know, we look at these yield curves each week to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the US, UK, Canada, should give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against future in longer term fixed income securities. Now, negative yields below that pink line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. The Japanese curve is now negative up to 15 years, and in essence, you would be paying to own the safety of Japanese government bonds as opposed to them paying you to borrow your money. Not a good sign for the Japanese economy, although longer-term yields this week were a little bit higher. The U.S. saw a little steepening in the 2 to 8 year area with better retail sales data, and Canada saw slightly higher short-term yields. UK yields flattened with more Brexit uncertainty, and the German yield curve was little changed. Well, as we did last week, and we will continue to do well into the future, we're going to continue to watch the U.S. yield curve. This week, just to recap, back in 2007, the U.S. Federal Reserve was tightening monetary policy rather aggressively and pushed 2-year yields to a point where they were even with the 10 and 30-year yields. And the yield curve ended up looking like the yellow one on this graph, slightly inverted. So if the Fed raises rates or longer-term yields fall, or a combination of both, then the yield curve flattens. When the yield curve flattens, a recession will likely not be far behind. And that is that is why we watch how these yield curves are shaped and what they are telling us. It is telling us that if the Federal Reserve does raise interest rates, then the probability of a recession goes way up. High yield bonds are lower, and the S&P 500 is lower. But one thing is certain, the historical relationship has been turned a little upside down by the central bank monetary stimulus. Investors cannot decide if they want more or less risk on a day-to-day basis, so they jump from one to the other. When the picture is not clear, we think it is best to remain on the sidelines. And as for equity market value, when investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric that we measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.3 times. The 12-month forward price-to-earnings ratio is currently at an expensive 16.6 times. Last week, it was a little bit cheaper at 16.5. At the equity market highs back in May of 2015, it was 17.1. So, given the economic circumstances and the uncertainty at the moment, it's hard to justify buying these expensive stocks. Well, it is earnings season, but we're right at the tail end. But downward revisions to earnings estimates and estimated year-over-year earnings decline for the first quarter is now negative 7.1%, which is below the expected earnings growth rate of 0.3% at the end of 2015. It will be the fourth consecutive quarter of negative earnings growth. Now, on average for all of 2016, analysts are projecting earnings increases of just 0.9%. At the beginning of the year, they were actually expecting a significantly larger growth rate of 7.4%. That's a lot of a change. So, with stocks as expensive as we see them, it's just not for us time to be buying at the moment. And as I've been mentioning for the last couple of weeks, companies often purposely lower their estimates so that when they announce results, they can look like they beat the lowered estimates. On average, over the last 5 years, 67% of companies have beat estimates. But thus far, in the first quarter of 2016, with approximately 91% of the companies having reported 71% have beat estimates, which is slightly greater than the average. The recent rally in stocks has pushed the enterprise value to earnings ratio, another metric that we like to monitor. It's pushed it back up above the 13 times, well above the longer-term average, which is closer to 10.5. And as we monitor corporate profitability, which is the white line, tends to lead the S&P 500 with a lagged effect. And of course, we see no reason for it being any different this time around. Well, in the past, we have suggested that corporate buybacks and not necessarily value investing have been behind the expense of stock prices. Now, according to a recent Bloomberg article, it states that after snapping up trillions of dollars of their own stock in a 5-year shopping binge that dwarfed every other buyer, U.S. companies from Apple Inc. to IBM Corp. just put on the brakes. Announced repurchases dropped 38% in the last 4 months, the biggest decline since 2009, coming amid the worst profit slump since the financial crisis. The slowdown may signal companies are preserving cash as economic and political uncertainty whips up from Europe to China and in the U.S. At stake is the primary source of buoyancy for the second longest bull market in history at a time when individuals and money managers are bailing out and valuations sit near 14-year highs. And as profits fell for a fourth straight quarter, the number of firms slashing dividends rose to a 7-year high. Meanwhile, investors continue to sell large amounts of U.S. and international equity funds and ETFs as earnings hit their fourth consecutive quarter of negative growth. So all that technical stuff we talked about at the beginning, where volume is higher on down days, where sellers have greater levels of ammunition, this is all being certainly reported on and documented here in some of these charts. As well, the gap between investor sentiment and pricing remains wide. And of course, as I say each week, when investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell, so the margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year, and the most recent data show that the trend is continuing. And of course, we also talk about and monitor the spread between large cap markets like the S&P 500 when they widen out over the small cap markets like the Russell 2000. It is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. The markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied more than the broader Russell 2000 has lagged. It makes us cautious. And notice that volume data for the S&P 500 shows greater volume on down days and lighter volume on up days. As I said before, it means the buyers are not as convinced as the sellers. And here's another indicator that we're just bringing to light, but we found this interesting as well, related to our unemployment theme. Historically, jobless claims have an inverse relationship with stock prices. So as jobless claims fall, stock prices tend to rise. When jobless claims start to rise, though, as we started to see last week and the prior week, there was, we're waiting to see the reaction, and so far it looks like it's, with the S&P 500 being the worst performer in the developed world this week, it's having an impact. We'll be watching every Thursday now for the jobless claims data to see how that will be impacting and if it will impact unemployment data in the longer term. Well, what does it all mean? Again, as we say and have been saying regularly since last May, we have taken a very cautious and defensive posture to investing. And in light of our key theme for 2016, we remain defensive because we see few, if any, good buying opportunities at the moment. And we monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we remain very cautious. Cash and cash equivalents have been and continue to be important defensive assets, so we're carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecasts, your goals, risks, tolerance, and time horizons. However, The ongoing research and analysis that we do at HighRock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance. Rebalancing on a regular basis is crucial. I do talk about this on our introduction, but I'm just going to bring it back up again today because I think it's important. Different asset classes will outperform or underperform at different times in a market cycle. Now, selling the outperforming assets and buying the underperforming assets will continually add value and return to a portfolio. Now, we also analyze each asset class to ensure that it is appropriate for each client's strategy. If an asset class, like the preferred share index, attains a higher level of volatility and becomes less suitable, which it has done recently, we will reduce our and your exposure to continue to maximize risk-adjusted returns. Paul laid out a few top picks for our models back in a number of weeks ago when he was on BNN. You can certainly peruse our website on the In the News tab to see that whole episode replayed, or you can check out the Globe Investor article, the link below there. Our clients will have exposure to these picks depending on timing and value as we see fit, and of course in keeping with your long-term strategy. As you all well know, we have 3 HighRock models that are used to try to get the best that we can in asset allocation, balance, and diversity. We do depend more heavily on the tactical equity model at this particular point in time, and Paul has been doing a lot of work researching to determine if there are some value stocks, value bonds that he can place into that tactical equity model that will help offset what is happening in the global equity model. And as we all know, the All World Index over the last year has come off about up at this juncture about 5.5%, but a blended combination of the global or the All Country World Index, which is our benchmark, and the fixed income benchmark, which is the Canadian Bond Index, has had a return of about negative 2.75% over the last 1 year. Our client portfolios should be well ahead of these benchmarks depending on their duration and structure. And a lot of that has to do with what Paul is able to accomplish in the tactical equity model, what the fixed income model is bringing to the portfolio, and of course our ability to keep costs as low as they possibly can. All right, what's up for next week? Well, we will see a little bit of data this evening from Japan, but none of us will be awake, so we'll talk about it in the morning. First quarter GDP is announced. Also tomorrow we'll get some inflation data for April out of the European area, Euro area. April retail sales from the UK on Thursday and Canadian April CPI on Friday. This weekend, G7 finance ministers and central bank governors will meet. Then on Monday, of course, the Canada Victoria Day holiday, we will not be in our offices. However, we'll be back on Tuesday for our HighRock webinar, and on that day we'll also see some manufacturing index for May from the European Union, get the latest news on that. Well, that's it for today's discussion. If anyone, actually we're out of time, so I apologize. If you do have questions, you wish to email them to us, we would be more than happy for you to send them. We'd also love to get feedback on these webinars, what you think is good, what is not, or what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. Have an excellent rest of the week and a wonderful long weekend if you're in Canada. Don't forget to tune in next Tuesday, and until then, this is Scott Tomlinson signing off.